Hello and welcome to today's webinar. We'll just let a few more attendees join and then we'll get started in about 1 minute's time. Okay, it's just past 11 now, so we'll get started. Welcome everyone to our masterclass today on navigating your investments in uncertain times. My name is Matt Conradi and I'm the Deputy CEO and Head of Advisory at Netwealth. I'm joined today by my colleague Simon McConnell, who's a Senior Portfolio Manager and Head of Portfolio Construction. We're going to take some time to help you think about the uncertainty that is going on in markets at the moment. We've got lots of things happening around the world, geopolitical risks, wars, we've got Trump's tariff policies and just his general approach to communication around policies that certainly has caused markets a little bit of uncertainty. And what we're going to help you try and think about today is how you can navigate through that, how thinking about your financial plans, your purposes for your goals, and how you might invest will make a difference through time. And Simon will spend some time thinking about and talking through the Netwealth approach, how we think about building portfolios and helping for a given level of risk to navigate through those different areas. We want to answer your questions throughout the session as well, so there is a Q&A tab. Please do submit questions in there as we go through. The session is recorded, and so you'll be able to access that afterwards if you are unable to keep up with any of the different parts as we go along. But we will try to cover all of the different topics that come up, any questions that you raise, and so please do, as I say, submit those through time. Some of you will have signed up for a one-to-one session with one of our advisors. These are a complimentary session for you to take some of the learnings from today and think about them in your own personal circumstances and portfolios. So if you haven't yet signed up for that, please do think about doing that. It'll be a really great way for you to chat through with an advisor about what you're trying to achieve, how you're set up today, and what you could do to help you navigate through these uncertain times. We'll drop the link in for that into the chat later on in today's session if you haven't got it to hand already. So to get us started though, I'm just going to share my screen and bring up some of the slides that we prepared to go through today. So the main topics we're going to look at are what the current outlook means for investors, how to prepare your portfolio for market volatility, and maximizing financial planning and tax efficiency opportunities when thinking about all of this in these uncertain times that we certainly are living in. Before we get started with that though, what I wanted to do is just sort of take a moment to step back and think about why investing is important. So why are we even worrying about it? Because one solution for thinking about uncertainty is just to say, you know, I'm going to sit in cash. And cash is that great thing. It gives you comfort of certainty of returns. You don't have to worry about fluctuations, but it does have downsides. And one major downside is inflation. What this chart helps us think about is that, of course, there's a role of cash in portfolios, but perhaps having too much in cash can be detrimental. And even actually in difficult market environments, it can make sense to invest if you have a long time horizon, if you can weather some of the ups and downs. So this chart looks at £100,000 invested at the end of 2007. So of course, the first year and a half of investing was a pretty difficult time. Financial crash came about, and the light blue line, which is a balanced portfolio after inflation. So these are returns after inflation for both cash and for the balanced portfolio. The light blue line goes down pretty badly, and relative to cash, which is the dark blue line, we saw quite a big difference. But if you fast forward a few more years, even though there are a number of other ups and downs that go along, European debt crisis, Brexit, more recently the COVID-19 pandemic, and the ups and downs that we've had in various other ways along the way, you'll see that you get a significant benefit to having remained invested after inflation. So the cash amount is only worth £66,000 in real terms, whereas the invested portfolio has managed to grow in real terms, so above inflation, to 115,000 through time. So yes, it was higher at one point, but you still, even after a pullback over time and a period of significant inflation, have you seen the benefit of investing here? So that's why we want to think about investing. And if we are going to invest, how can we try to mitigate some of the risks to us of maybe being a forced seller or an uncomfortable seller when markets are more volatile? What we have to acknowledge is that for a lot of people, they think about cash or equity markets. We'll talk later on about the differences of the things that you can consider. There are a range of different portfolios you can construct and investments you can have that won't necessarily react like this. But if you are thinking about equity markets, you have to accept that they will be volatile. And uncertainty will come about for various different reasons, and it will drive ups and downs in portfolios through time. Broadly, equity markets go up through time, and they generally outperform inflation, but they are, in most years, experience some level of volatility. This chart looks at annual returns and intra-year drawdowns. So what's a drawdown? It's the peak to trough. So the biggest sell-off. If you'd invested at the top point in that year and sold at the worst point, what your return would have been. So the light sort of purpley bar at the bottom, the negative periods are the worst drawdowns. And the darker bar is what the year-end return ended up as. So what we can see is it's quite common to have a minus 10%. In fact, most years, equity markets at some point in the year will fall around 10%. In the really bad years, it might fall over 20%, and that's often defined as a bear market. But actually, quite often, even in those bad years, you end up with a positive calendar year return. So if you stay invested through the whole period, you get rewarded for that. And I think 2020 was one of the most extreme examples of that with the pandemic, where we saw equity markets, if we look at the bar for 2020 here, were down 33% at one point. But by the end of the year, this is MSCI World All Countries, so a global equity index, was up just under 20%. So it makes a huge difference through time to stay invested. And what we're trying to do, and we'll talk about this from a financial planning perspective, is how can we make sure that you don't have to sell at this moment in time? And either that's because you need the money or because you're so uncomfortable. And we'll talk about how you can think about building a plan that navigates around that. If you are going to be invested, Simon's going to talk about and think about how you can make sure that perhaps these drawdowns aren't as bad as they could be. And there are ways to mitigate some of this up and down through time by the way we construct portfolios. And I think what I wanted to just focus on now for a moment is what we've seen year to date. So the other bars in this chart are the calendar year returns. But on the right-hand side, what we have is the 2025 year to date up until the 6th of May. And what we've seen is that although when we had at the extreme moment of uncertainty after Trump stood on stage and held up his card with all those different tariff rates, we were at minus 16%. We're actually seeing slight positive returns for equity markets, global equity markets now for the year. And that's, again, really interesting for us to observe, because if you try to time in and out of that, it's really, really difficult. You can find yourself having sold at minus 16 and now wondering whether you should buy back in positive territory again. That can be really difficult. What Simon's going to do now is talk a little bit about what's happened, how we've got to this, and how that experience has played itself out over the last few weeks and months.
Thank you, Matt, and good morning, everybody. Thank you very much for joining. So yes, as Matt mentioned, a period of significant volatility for markets, clearly prompted by the imposition of tariffs by President Trump. You've then had subsequent escalations with China, the second biggest global economy, and then some rowing back of the initial announcements. So a 90-day pause on those initial tariff announcements. Now, what I wanted to highlight here was that absolutely there's been a lot of noise, a lot of media narrative, a lot of headlines that perhaps have been quite alarming. But I wanted to take a moment and actually have a look to see how the Netwealth portfolios have performed in such an environment. And so if we move to the next slide, please, Matt. So what you can see in this table here, the 1 month return shows the return that portfolios exhibited during April, and the year-to-date column on a year-to-date basis. We show returns relative to our peer group, but also importantly relative to global equities. And actually, I think what I'm trying to highlight through this table is sort of the juxtaposition of media narrative and headlines that you've seen, and actually the returns that portfolios have manifested. So actually, three key points. Let's say, firstly, it's about the benefit of being diversified. So we'll come on to talk more about this later on when I talk about portfolio construction. But all of our risk levels comprise of different markets, different asset classes, and building a portfolio in that way has allowed them to substantially outperform global equities, which have detracted by 2.5% in sterling terms on a 1 month basis, and 7.1% on a year-to-date basis. So that's the first thing, diversification. The second thing, which I think is actually true throughout your investing journey, but can be exhibited through these numbers as well, is that often one's perceptions of risks, and there's always something to be worried about in terms of markets, something coming down the line that could, you think, perhaps knock off your performance. But however, often those perceptions of risks don't actually manifest itself in portfolio returns. And I think, you can see the sort of modest positive and modest negative numbers on this 1 month basis, despite the headlines that you've seen show that as well. And I think the final thing, which Matt will come on to talk about a little bit later on, is how that choice of risk level, that choice of risk tolerance, is also a real sort of tool in your armory around mitigating volatility. And you can see there on a 1 month basis, risk level 1 to 3 are in fact in positive territory, and on a 1 month basis, on a year-to-date basis, 1 to 4 the same. Over longer time horizons, you can see that on the right-hand side of this table, on a 12-month basis, all portfolio returns are now positive, but still that element or that aspect of choosing a risk profile that is suitable for you is very evident. Whereas when we look over a longer time period, so since inception, which for us was the end of May 2016, the annualized returns show a greater degree of sort of monotonicity according to the risk level we've got there. So I'll hand over to Matt. He'll talk a little bit more and give some more evidence about the importance of risk tolerance over a longer time frame.
That's it. So I think what you've seen there from the returns that Simon was talking through is that different risk levels will respond in different ways, and we can have more certainty about having positive returns depending on your time horizon. So what we try to encourage people to do is think about what they're investing for. Why is a portion of money being invested, and over what time period is it likely that you might need to draw from it? So if you're in your 40s and you're investing for your retirement, that might be 10, 15, 20 years away. So you've got a long time horizon. And if you are taking more risk, you might be able to afford that level of risk if you have a longer time horizon. If you have a shorter time horizon, let's say you've got some cash that you've sold your house and you're going to buy another house in a year's time, you may not be in a position to take too much risk with that, because the problem is that you haven't got time to recover from any ups and downs that occur. So although we've seen a quick recovery from this most recent period of volatility, sometimes the recovery can take a while. And what this chart here tries to show is that for different time periods, so we've got the columns on the left-hand side of 1 month, then we've got 6 months, 1 year, 5 years, and 10 years. The percentage of times over the past 25 years, in fact 30 years, you would have had a negative return from a different risk level. So over 1 month, what we see is that risk levels 2, which is the dark blue bar, risk level 4, which is our balanced portfolio, is the grey bar, risk level 7, which is our equity portfolio, would have seen negative returns on a 1 month period around 35% of the time. So the first positive thing to say is 65% of the time, you're seeing positive returns. over a 1 month time period. But it shows you that you can't be particularly certain over 1 month, even at lower risk portfolios, what will happen. You probably need to be down in risk level 1 or cash to have something that will give you certainty over a 1 month period of time and reduce your risk of capital loss to very, very small levels. Over 6 months, you can have a bit more certainty. Risk level 2 is now only seeing negative returns over 6 months in 15% of times over that full 30-year period. But risk level 7 is still up near 35. If we go all the way out to 5 years, what we see is that risk level 2 and risk level 4 have no negative periods over 5 years. And risk level 7 only has around 15% of the time. And that could have been the reality with equity markets is you can have been seeing really good returns for 4.5 years, but then you'll see a negative period in that last moment. And because the negatives in equity markets can be quite significant, they can be minus 30s, you still end up with potentially a negative return, even though you've accrued some good returns beforehand. Whereas if I go out to 10 years, what we see is that no periods where you've got negative returns. So that's really interesting to observe. So you can have confidence if you can invest for 10 years that you can afford to take equity market returns and you shouldn't be losing money through time. And so if you can think about your different goals and objectives and match them up with these your time periods, then you match your risk level with the level of time that you have for investing. That can make a big difference to whether you're at risk of losing money. So this is all about being able to stay invested, not be a forced seller. We have to acknowledge that you might become an uncomfortable seller though as well. So riskability defines the fact that you can afford to stay invested, that you don't necessarily need to take money out from that pot over time. But risk tolerance defines whether you're going to sell at the bottom of the market because you can't withstand that up and down. And the way we help clients think about that is saying, look, there's a range of outcomes for different risk levels. So we offer these 7 risk levels: risk level 1, cash-like, up to risk level 7, global equity type returns. And we need to be comfortable that we're happy to accept the ups and downs that will come through time with these. So the strongest market return at risk level 7 is plus 42.7%. But the counter to that is the worst 12-month return is minus 28%. And in intra-period, in a 12-month period, it could have been worse than that as well. And so you need to know when you're investing in that portfolio, that's the journey that can happen. It won't happen all the time. It won't happen every single year, but they can happen. And you need to be prepared to ride that storm and get to the positive returns on the other side of that as well. And if you're not comfortable with that, then there are other ways to invest in the middle ground somewhere that you might be more comfortable with. And only you will know exactly how you feel about that. But again, if you break your investments down into different pots for different purposes, you might be much more relaxed about the fluctuations that occur in something that you know you're not going to use for 10 or 15 years than that pot of money that is your safety net or something that you have earmarked for a specific need in the short term. And so you can match those two things up so that you can get you can feel comfortable and remain invested, not be a forced seller, and ultimately maximize your returns through time as well. We think that's really important and quite different to the way that lots of wealth management companies think about it, where you do a risk tolerance questionnaire, you come out as balanced and everything ends up in a balanced pot. We don't think that's the right way to think about your different goals and the different pots of money that you have. To emphasize that though as well, I just thought it's worth bearing in mind that for some of you, you'll be thinking about drawdown type goals. So it's not, the money might be lasting a long time in total, but you are drawing from it every year. And that is important to deal with fluctuations through time. Simon's going to talk about how we can use different elements of portfolio construction to try and deal with some of these fluctuations and some of the things we're seeing as we look forward today. But I just wanted to show an example of something, again, through a difficult market environment. So this portfolio starts at the end of 2007. It's very similar to that cash versus investing line we were looking at before. But this time they're drawing money out of it every year. So they are selling each period of time to get their 18,000 a year withdrawal from their 250,000 pound pot. The portion that's in cash runs out in December 2022. The invested portion, although it was worse off for a period of time at the beginning, ends up at the end of 2022, where the cash has run out, having nearly £100,000 still remaining. And that's the benefit of accruing returns of investing over time. So it's okay to be drawing down from a pot of investments, even if they have volatility, as long as the level of drawing is not too great relative to the size of the pot. So if you've got 250,000 and you need to draw 150,000 in 6 months' time, you need to split that into two pots probably. But if you're drawing 5% or so from it on an annual basis, I think that's very manageable. And what we can do is try to think about how we mitigate the fluctuations for you, so we can cut off some of the drawdown potentially through time by thinking of some of the sensible things we can do in portfolio construction and managing that on a professional basis for you as well. That really heavily relies on diversification. And some of you may have seen a chart like this before. What this looks at is for different annual periods. And for this one, we're looking 2007 through to 2022, same period as above, and says, look, each one of these little colored blocks is an asset class. And asset classes will have different characteristics. So the light pink one in the top left-hand side is emerging market equities. The white one at the bottom, or the grayish white one, is REITs. So that's real estate investment trusts, so investing in properties. And they have very different returns in 2007. If we fast forward to 2015, kind of in the middle of that, you can see REITs are now at the top and emerging market equities are right near the bottom. The point is, actually, there's not much of a pattern here at all. It's not like you see certain asset classes always at the top or at the bottom. The only bit that actually is quite consistent is what we've called the portfolio. So these white blocks here that are the portfolio, it stays roughly around the middle each time. You're getting not the worst outcomes and not the best outcomes through time. And that's kind of what we want to do when we're building a portfolio for clients, so that we can make the path of return slightly smoother by blending together these different asset classes that have different characteristics through time. Okay, I'm now going to hand over to Simon to talk a little bit more about how we actually do this at Netwealth.
Thank you, Matt. So, talk about investment approach. In a nutshell, I'd categorize it as active asset allocation with passive implementation. Now, what do I mean by that? On the slide, you'll see the three core tenets of our investment process. Let's start on the left-hand side with what are the most important driver of risk and returns in the portfolios. That is the strategic asset allocations. So once a year, we come together, we formulate expected returns on all asset classes, and we create these portfolios, which would be, if you were to ask me today, build me a portfolio for the next 10 years and put it in a box and leave it there, that's what our strategic asset allocations would be. And something that is designed to meet the objectives that are suitable for each risk level by combining asset classes, regions, sectors, currencies, in a diversified manner that mean that the risk return characteristics are aligned with our objectives. Now, we're very aware that the returns on that strategic asset allocation can be put at risk through time. Might that be due to event risk, perhaps, or it could be policy risk. So maybe interest rates in one country might be rising faster than in another. Or even, actually, during the course of that investment landscape, there might be just excessive valuations in one market, which prompt us to take decisions to alter from that strategic asset allocation. And that's where cyclical positions come in. So that is, we're taking active decisions to alter the composition of the strategic asset allocation with the goal of smoothing the path of returns through time. And I think that's really important. If you think about our risk level 7 portfolio, which I'll come on to show you, has broadly equity market, equity-like characteristics, that if for whatever reason we were starting to become a little bit more defensive on the equity markets, we're not just going to slash the equity exposure within the portfolio by half, because actually that risk level 7 has then become broadly a risk level 4. However, we will make considered views around how we can alter the composition, whether it be through currency, market, sector changes, such that we can smooth that path of returns for clients. And I think that's important in terms of actually mitigating those drawdowns allows clients to feel more comfortable with their investments and sort of meeting their objectives of the long term, rather than making some knee-jerk reactions in the short term in the face of volatility. So strategic asset allocation, actively reappraised every 12 months. The team are continually looking at markets on a daily basis, looking for opportunities, looking for risks, and taking active decisions to alter from that or make cyclical adjustments to those strategic portfolios to smooth the path of returns. However, we then combine those together with passive implementation. And what do I mean by that? So given we've made a decision to access a particular market, we have to choose what investment funds to buy to give us that exposure. And on one hand, you have the concept of an active fund, which is where you employ a stock picker, essentially, to choose the best or their perception of the best stocks within that particular market. So, for example, a UK active equity manager might be trying to outperform the FTSE 100 index. Whereas the approach that we take at Netwealth is to invest in predominantly ETFs, which are exchange-traded funds, or index funds that actually track market indices that we're looking to follow. And the main reason for that is that actually we think there's a whole host of empirical data that show that actually over time choosing an active manager ultimately leads to underperformance versus that index return. So we believe in investing in a very cost-efficient manner and using passive vehicles to deliver the market exposures that we want to do. Now let's sort of put that into practice and sort of show you what the portfolios look like currently. And you can see our 7 risk levels here. Let's focus on the top chart to begin with. As you transition from risk level 1 to 7, risk level 1 is sort of very low risk. A lot of sort of cash-like instruments and money market instruments and some short-term fixed income. You transition away from these instruments into sort of higher allocations to core fixed income, longer dated government bonds, and also as you transition through the risk spectrum, you get a higher allocation to global equity markets. But also the bottom chart shows you get a higher allocation to foreign currency as well. So whilst risk level 1 has 100% allocation to sterling, which is the dark blue sort of bar or set of that bar, you see how that diminishes as you increase through time. And our job as portfolio managers is to understand the interaction and the correlations between all the different asset classes that allows us or delivers a sort of portfolio that has the risk return characteristics that we're looking for. If we take a bit of a deeper dive into risk level 4, so the table on the left-hand side looks at how we've chosen to fulfill those asset classes or those asset allocations that I previously mentioned. So, for example, let's just take US equities on the chart. See, it's on the table, a 12.6% allocation. But we've made an active decision not to just buy the S&P 500 index, but actually to diversify that by also buying an S&P 500 equal weighted ETF, and also access the sort of the mid-cap part of the market. So part of that decision was driven by the fact that we thought that a lot of the sort of the Magnificent Seven names were highly expensive, and so we've made some choices, some active choices, to diversify away from that broad market cap weighted benchmark. However, the instruments that we've chosen, as you'll see as you go down the list, are all ETFs, or predominantly all ETFs. And that again is down to the desire to get access to the markets you want to in a very cost efficient manner. Following on, I wanted to highlight how we've changed our asset allocation through time. So again, emphasis on sort of the continual active decision making that the team are doing to shift the portfolio composition in the face of perceived risks. Three things I'd like to highlight from this chart. The first, let's begin with equities. So the green bars at the top, or the green sort of segments at the top, show that the composition of equities by regional blocks. Now, if we were to just take a naive market cap weighted benchmark, that has about a 2/3 weight to the US. And we've been taking steps to reduce that weight to the US for the aforementioned reasons I mentioned about the fact that we think valuations are quite challenging. We've increased our allocation to Europe and the UK, flip side. Secondly, now if we look towards the blue bars in the middle, this has been our exposure to fixed income. And historically, in our risk level 4 portfolio, we utilised a lot of government bonds, but also a lot of sort of riskier fixed income, whether that be through investment grade, so corporate credit, or even high yielding credit, so riskier borrowers, sometimes referred to as junk bonds, that give you a higher yield. Also, emerging market issuers too. However, we've been making steps to reduce exposure to these companies and issuers, for the reason that we think that the additional compensation that you get for investing in these companies isn't worth the additional risk. And then the final point I'd like to mention is the increasing allocation that we've made to alternative asset classes in this portfolio, and that's the sort of big orange block, and particularly to gold and trend followers. So there, that is again about the desire to increase the diversification within portfolio. So ultimately seeking for different drivers of return that perform well or perform differently to traditional asset classes in certain market environments. And we certainly believe that the characteristics of the portfolio have been enhanced by adding these assets. Which now then brings me back on to today and the current market landscape. Now, whilst I showed you the sort of pretty muted portfolio returns over the period, actually that covers over a lot of rotation and underlying volatility within markets. And the chart here shows the sort of the dark blue bars, the returns for April on the core holdings within our GBP portfolios, and then the coloured bars show that the year-to-date total return ordered by equities, fixed income, and alternatives. And I think, yeah, the key points to make here is that actually diversifying away from the US and having less of an underweight, or having less of a lower weight compared to a naive market cap weighted benchmark, has been to the real benefit of portfolios, as US companies have underperformed, whereas European and UK equities have done particularly well. In fixed income, the decision to sort of diversify away from riskier borrowers towards sovereigns has been additive, but only marginally. But the increased allocation to gold has certainly been a big addition to portfolio returns.
Thanks, Simon. I think that nicely sort of shows how the process works, how we think about using those passive funds in portfolios, but are careful about the strategic allocations and then some of the adjustments that we can make through time, because a pure market weighted passive index can build up its own issues over time. The US is a good example of where that great performance returns itself into potentially risks as well through time. And diversification is one of the things that we try to embed into portfolios always. I think now it'd be great if you could talk a little bit more about the outlook. I know many people on this session will be thinking, okay, great, that's what's happened, but what next? How do I think about the portfolio and adjustments that might need to be made through time?
Happily. So looking forwards, I think the starting point is certainly that levels of uncertainty are very high. There's in my experience, often policymakers or periods of volatility have occurred due to sort of specific market risks that often policymakers haven't been fully sort of able to combat. For example, I mean, COVID, the pandemic, is a great example how there's no real amount of interest rate cuts that can offset the need for vaccines. In this instance, it's a really tricky environment because actually a lot of the uncertainty has been created by policy, which potentially could be reversed at any time. So we've got to sort of be aware of that. What are we looking at in the investment team? Certainly, you've had a period now where sentiment data, survey data has deteriorated quite substantially. But we're in that sort of little lag period where we're awaiting hard data and actually what has economic activity been like after, well, I guess the announcements, but sort of the longer term impacts once the 90-day pause has elapsed is also to be seen. I mean, let's not forget that even in the current situation, sort of pretty much a trade embargo between sort of Chinese exports to the US and the two biggest economies in the world is a challenging environment for global trade. So we need to see what the details and the numbers are. Subsequently, how are corporates going to react? Are they going to, particularly in the US, are they going to pass through the impact of higher tariffs onto consumers? Are they going to eat that into their profit margins? Are they just going to sort of sit still for a little bit and hold tight for investment and to see what happens later down the line? Or actually, in the short term, are they likely to lay off staff and unemployment rates rise up? Certainly, a lot of uncertainty there. And of course, pretty relevant, I think, given today's news that when in this 90-day period, there's going to be lots of negotiations around trade deals. I mean, there's some headlines around the US and the UK agreeing something today. But actually, the shape of those new agreements will be really important for the outlook for the macroeconomy. Carrying on, certain countries are going to react in different ways. So is there a possibility that domestic policy announcements then are enacted to offset the impact on growth? So you might see that in monetary policy. I think you're likely to get a cut from the Bank of England today, or perhaps in fiscal policy. So China and Canada in particular are expected to ease fiscal policy to boot demand. Let's look forward, thinking about markets now. Now, I know the team are doing lots of work. We're continually assessing and actually looking for opportunities, because often when you have a period of volatility, there can be mispricings. And certainly we're looking for ways to exploit those. And that may manifest itself in many different ways. Perhaps what actually are the beneficiaries of these new trade policies? Does a more sort of fragmented trading landscape favour certain countries over others, or perhaps are countries that have a higher domestic revenue base more likely to outperform going forward? And I think the final point, and I think this is a really big question, is around the outlook for US assets. Now, certainly, and I think our starting point coming into the year was that we believe that US assets begun the year as expensive. And the chart on the right-hand side looks at sort of pretty much a metric showing the valuation of the US dollar, and which looks expensive relative to history. And certainly after the election, a lot of people got pretty euphoric about the concept of US exceptionalism, and sort of valuations became really expensive, and positioning got very much one-sided in favor of US assets, which has now sort of unwound somewhat. I mean, I've seen some pretty sensationalist headlines around the idea of the US being uninvestable, which we certainly don't agree with. But the fact is that the starting point is that US assets are expensive, and we need to sort of factor that into our future thinking. The flip side, however, is that, and we talked about this just after the president was elected, but you need to think about his policies in the round, and actually the potential for other impacts. And yes, absolutely, we've seen the bad in terms of tariff policy and the negative impact that it might have on the global economy. But other things that he talked about in the run-up to the election, which have the potential to be enacted later in the year, tax cuts and deregulation, certainly could be a sort of real positive for the domestic US economy and also markets there. So a lot of things going on, a lot of uncertainty, but a lot of opportunities that we're sort of continuing to look at. And to finish, I just wanted to finish my part. From my side, yes, volatility can be testing, but actually often it does create good opportunities for investing when you've got a long enough time horizon. So the chart on the left hand side it's called the VIX index. It's a sort of widely followed market-based measure of volatility, and yeah, we've had a VIX spike of above 50. The table on the right hand side shows the subsequent 6-month returns on the S&P 500 index after the VIX has breached a certain level. And you'll see when the VIX has sort of breached 40 on a forward-looking basis, on average, so clearly there's it's sort of right and left tails to the distribution. On average, that forward return is pretty substantial, 18.2%. So yeah, sort of reiterating the messages: stay diversified, but actually the risk of being uninvested is often greater than the risk of staying the course.
Thanks, Simon. I thought we'd just take a moment actually to go to one of the questions that came in, which is relevant about the portfolios, how we cover, but also what's been happening of late. So it comes in here and says, given your coverage of US assets, how do you deal with the FX risk when for a GBP returns? Because US investments have certainly been impacted by that as a GBP investor since tariff day. Yeah, absolutely. It's a great question. And one that really forms an integral part of our investment process. So if you think back to how I talked about the investment approach, from a strategic basis, all of our US equities and all of our Japanese equities we hold on an unhedged basis. And the reason for that is that often during periods of market stress, the currency tends to act in a counter-cyclical manner. What do I mean by that? So actually, broadly, historically, when equities are selling off, owning dollar assets and yen assets, the dollar and the yen have appreciated relative to sterling. And I think you're absolutely right that in this period of market volatility, the sort of diversion from history has been that muted performance of the dollar in that sort of environment. And that is, I think, a key question for us going forward. And I think it's sold off quite a lot and looking pretty oversold in the short term, but more structurally on a long-term basis, actually assessing whether that sort of diversification benefit from the currency is likely to come true. And I think we've sort of wrapped that into actually our asset allocation views, and that having a diminished weight to the US equity market relative to a global equity market
naturally means a lower allocation to the US dollar as well, which we agree that both aspects have been expensive.
Thanks, Simon. A follow-up question actually that came through was just about yen hedging and how that might have adjusted through time. Maybe you could just touch on briefly how we're always reviewing this and that we do make adjustments to our currency hedging.
Yeah, entirely, and it follows on really nicely. So again, like our starting point has been that we don't hedge Japanese equities on a strategic basis. Have more recently, we've made cyclical adjustments to actually hedge some of that yen into US dollars, because I think there was a real positive carry argument. So you're getting a positive return from the interest rate differentials there. And so yeah, we had that cyclical position enacted in portfolios. We actually took it off when the yen dollar cross rate was in excess of 160, and I think now we're trading back down at about 144. So starting point, again, to emphasize, fully unhedged from a diversification perspective, but absolutely making active cyclical views according to everything the risks are in the market.
Great. Thank you very much, Simon, for that. Please do keep your questions coming in. We'll try to answer them as we go along. And if not, we'll deal with some of them at the end as well. I thought I'd turn now, though, to thinking more about financial planning, and how making sure that you're thinking about your goals, your objectives, and how you're setting yourself up can make a big difference to navigating through these uncertain times. So I'm going to share my screen again. Because I want to think specifically about some of the things that we do with clients, and show you some of the tools that we have as well. You've all got the ability to take a one-off session with an advisor for free. This is a guidance session, and we always are available to offer guidance to our clients to help them think about what they're trying to achieve, to help them think about how they're set up as well in their portfolios. And if they want a more structured approach, we also have our financial advice services, and they'll cover a whole host of different areas depending on what your stage of life is, what you're trying to achieve. It might be looking at your current asset allocation, thinking about those pots and what should be at lower risk or high risk. It might be thinking about that in the context of retirement planning and the specifics of how you draw down. So which pot are you going to take money from a tax efficiency perspective, or it might be which pot are you going to take money from because it's relative to the risk. And we talked about not being a forced seller or having too much volatility in a pot you're drawing from as well. There are other areas that will overlay on top of that. They might be things like looking at cash flow modeling or estate planning or investing for children as well. So if that's relevant and of interest, we have our advice service that's there. You can talk about these things with advisors in that guidance session, or you can also have one-off advice or ongoing advice as well. But let's look at some of the tools that you can also access when thinking about these things, because some of this you can talk to an advisor and then think about it and plan for it yourself through time. And I wanted to show you some of our financial planning tools that are available. So if you are not already registered for this, you can go to my.netwealth.com, and you can access these tools that I'm about to show you. So let's have a look now. In here, we have both a wealth tracking tool and a wealth planning tool. And these can be really powerful, because one of the first things you probably need to do is understand where you are today. What are your assets? So for this individual, they've got 630,000 split across some pensions, some taxable investments, and some ISAs. And their overall asset allocation is around 60% in equities, 30% in fixed income, and around 8% in cash and other assets. But the question is, where are those, and what is the right mix for them to have through time? The way that you can build this up is you can just start to have your assets, you build in specific funds, and then we'll look through those funds and give you an allocation, because a number of you may well have things like this, the Aviva Schroeder Managed Balanced S6. I mean, I don't know what that means. Sometimes a balanced portfolio is a 50-50 equity bond fund. Sometimes it's a 70% equity fund. So what this will do is give you a look through of the allocation and help you understand that picture, which can be really helpful, just to get a sense for where you're positioned today, and is that the right thing in the different pots, and does it match up with your time horizons? What you can then do is go to the wealth planning tool, and start to look at how all of this fits together for the long run, with investment returns, tax, inflation, and thinking about longevity risk as well. So some of the things that are a little bit uncertain for us, we can start to get a sense for the range of outcomes and maybe some adjustments that we need to make. If we do this and we get our plan in place, then when market uncertainty occurs, we can be more relaxed about it because we will have pots that are there to protect us in that environment. We know that it's sustainable, a range of outcomes. Now, this person today is 50, and they are thinking about retiring when they're 65, right out here. They also have a goal of paying off their mortgage, which they think will be 125,000 in 11 years' time. And then they're thinking about having a net of income, net tax income target of £5,000 a month. But the goals look like they might be slightly off track here, in that the money is going to run out when they're 89. Now, lots of you may sit there and think, well, 89, God, that's a pretty long time away. I'm not worried about if the money runs out there. We tend to model to age 95 because one of the risks is longevity. And if you live longer, you don't want to have run out of money for that. So it's important to understand. You can always make adjustments to the plan over time, but what could this person do to think about that? The other thing is this set up in a way where if something unexpected happens, something that's not currently in the plan, have they got an emergency fund? Are they set up for that? So if we dive into this particular setup, we can look at their pensions first, which they're modeling a sort of balanced growth portfolio, a risk level 5 portfolio. And if you want to understand more about what those are, there's a little guide that you can click on and get more details about as well. They're contributing to their pension, which is great. So they're building up that pot over time. They've got some ISAs, which they're not contributing to, and they're invested in a mix. There's a balanced risk level 4 one here, and then they've also got a higher risk level 7, a growth focused sort of 90 to 100% in equity portfolio as well. And then in their general investment account, they've got this pot here, which is a balanced portfolio. Now, if we think about financial planning and weathering financial storms, what they don't have here is an emergency cash fund. And we tend to talk to clients when they're thinking about having a cash fund of having at least 3 to 6 months worth of their needs while they're working. And as they get closer to retirement, having 12 months worth of their cash flow needs. So it might be appropriate for this person to actually take this pot of £50,000 and put it into cash. And accept that although they're not going to get as much return in the long run, it means they can take more risk elsewhere potentially through time. But they might also need to adjust their plans. So if I go back and rerun this projection, what we'll see is by moving some of that money to cash, it actually looks slightly worse. And so they might need to make some more adjustments, either to their goals or what they plan to do with other elements of it. It could be that they could take a little bit more risk now that they have that pot. So if they go back to their ISAs, when this pot here was at risk level 4, they could maybe take that one up to risk level 6, take a little bit more risk, because they now know they've got that safety fund of the ISA, of the cash outside in the taxable account, which is the first place they'll withdraw from. And then over time, they can take a little bit more risk in their ISA, which will compound up tax-free as well. And they're a forced seller from that ISA because they've got that cash emergency fund as well. And we can start to see the impact of that through time, because some of these things are quite sensitive. That's one part. It slightly improved the outcome for them through time a little bit further. And this is where either you can play with the tools or advisors, again on a guidance free basis or on a paid for advice basis as well, to work out what the right thing is for you. What they might need to do is think about making some contributions. They might need to save a little bit more. So let's put into this pot here, they're going to actually make some contributions of £500 a month. And we can see what the impact of that is through time. So you can see you can pick different frequencies, different elements to that. We can go back and rerun that projection and see what that does for it. So regular saving to the point that they retire in their ISA is probably going to have quite a big impact actually for them, because they're putting £500 a month away into that. Now that obviously has an impact on their life today, but they may well be comfortable doing that, given that gives them more comfort in their longer term planning as well through time. So what do we see here? As this now projection builds forward, now we see that actually by doing that additional saving between age 50 and 65, they're in a stronger position. The pot lasts until they're 95, and actually we think there might be around £600,000 remaining at that point in time as well, in an average scenario for them. So they can start to get a sense for how they can adjust their plan to navigate and mitigate risks of things like uncertainty in markets, of volatility, and they can understand the trade-offs as well that occur, and how they want to think about their planning in that context. What I wanted to do now, though, was just go through a little bit of a summary through to the things to be thinking about when you're trying to go back and look at what you've got set up and how you might sort of navigate through these different environments, and try and summarize some of the things that we've covered today. We really need to understand that there are some things that we can't control for. So we can't really control for markets and volatility. We have to accept that we're looking for the long-term average returns, but there are going to be ups and downs. So we have to model for the range of outcomes that can happen. Same with inflation. So we've had a period of elevated inflation, but prior to that, we had a long period of low inflation, and we need to make sure that when we model forwards, we're not extrapolating the wrong, either too conservative in terms of high inflation or too beneficial in terms of low inflation. The same with longevity as well. So I looked at that scenario of 89. Well, the reason we model for a longer period is to make sure that we have a sense for the impact if we do live longer. Those are the uncontrollable things. But there are a bunch of things we can control. So although, again, we can't control what Donald Trump is going to announce in his latest tweet on Truth Social, we can try to make sure that we're set up to mitigate some of the other risks and do the sensible things. And our whole philosophy here at Netwealth is to focus on these things as much as possible. A big one of those is timing the market, not timing the market. It would have been very easy this year to have had that announcement, seen the market sell off and think, God, I need to sell now. I need to sell down. I need to mitigate the risk in my portfolio. But as Simon showed you with some of the returns that have bounced back so quickly, it would now be in a difficult position where you're trying to work out how to get back in. And the problem with trying to time the market is you've got to be right twice. You've got to get in and get out, or you've got to get out and get back in. And that's really, really tough to do. So our view is think about your time horizon, max your pots up with the right level of risk, and then just take that through time and accept there'll be ups and downs. In order to make it as smooth a ride as possible, diversification is really, really important, and being thoughtful about how diversification needs to be blended into a portfolio and how that will change through time. So the characteristics of things like currencies will adjust through time, and the characteristics of different asset classes will also adjust. So diversification is not a one-time thing. It's something that you need to keep an eye on to make sure you're still getting the benefits of diversification through time. Thirdly, what you can do is just make sure that you're taking advantage of all tax wrappers. I talked about ISAs a moment ago. If we're going to take a little bit more risk, let's do it in the ISA where it can compound up through time. That's really important as well to be thinking about. If we're using our allowances as well, and we'll try to do that as efficiently as possible for clients. So that might be how we draw down, it might be how we save into the future. If you do that, it's going to give you better net returns, irrespective of what happens with markets. And the fourth thing that's going to give you better net returns irrespective of markets is minimizing costs. We strongly believe that if we can keep the costs of investing low for clients, we can help them compound that benefit through time. It gives us better returns. And we've seen that play out both in our portfolio performance and for many clients as well in their goals and as they think about investing as well. Our fees are structured in a way where you can pick and choose the level of services that you want, but they try to be comprehensive. We have both a core service and an advised service that I've touched upon. And in our core service, you get your investment management, the custody and safekeeping of your investments, all transaction charges, administration, tax reporting, any applicable VAT. We try to be as comprehensive as possible. And you can see that depending on the level of assets you have invested by both yourself or in a wider network, which is where you can join together with up to 10 different investors, we look at the total level of investments. And once you're through a different threshold, the fee rates will drop down to those different levels through time. So we're trying to keep those costs as low as possible for clients. And if you want advice, then you only have to pay for that as and when you need it. So either you can have one-off advice, which you pay for by the hour, or the ongoing advice service you can turn on when you need it. So some people will start without it and add it perhaps at the point of retirement in the future if that's relevant for them to consider. The impact of that can be quite stark. So this is just an example of £1 million invested over time. And you can scale this up or down depending on the size of investments you have, but it's showing a 1% saving on fees. And we see this quite consistently compared to traditional wealth managers, a 1% saving on fees. And it has a huge impact through time. So if we look after 10 years, what we see is that you're £124,000 better off, or 12.4% of the capital better off after 10 years by saving 1%. And over 20 years, that's £380,000. It just has a massive impact. And this is irrespective of what's happening in those markets. It's just the fee difference of considering a 2.1% fee versus a 1.1% fee over time. And so although those percentages sound quite small, it's really important, and it gives us certainty. It's the hurdle that we've got to beat every year, and it can make a real big difference through time as well. I'm going to pause now and just dive back to some questions that we've had come in. I think one of the questions that keeps coming up is really just how we balance all of the different uncertain elements that are out there. So the question here is, how do you balance in uncertain global economy, like wars, pandemics, tariffs, the thinking about the portfolio? How do we think about blending those assets together and staying on top of all of those different moving parts as well?
Yeah, thanks. So I think the starting point for us is always considering traditional correlations between asset markets. So understanding how certain things react to certain market environments, and then how sort of to combine those together in such a way that all our eggs aren't all in one basket. I think it's really important in portfolio construction to have different drivers of return for different sort of market environments, because we can't say with certainty this is what's going to happen. Let's align everything in that direction. And I think that the second point, which I think is really, really vital, are around valuations. So valuations form the basis for long-term returns, in that if we think we perceive something is expensive, the likelihood that their future returns from that point are likely to be lower. So we sort of take all of those things into consideration, valuations, risks, policy, to try and sort of combine it in such a way that you have diversification across the different elements, but are still sort of are embracing risk such that you can get the returns that you need over a longer time horizon.
Understood. So yeah, it's continuing to do the sensible things, and I think that's true across everything that we do, is to be thoughtful, be sensible about what you can control and what you can't control, and then try to construct things so that you are on top of it and paying attention to it, and outsourcing that potentially as well, because it's difficult to do all of this yourself. So think about whether that might be the planning elements or the investment elements where you might need some support for it through time, because there's a lot going on, and it can be easy to overreact and to jump in and out of things as well. But there's a lot of different nuances as well to keep on top of through time. As I mentioned before, you can have that one-on-one session with an advisor if you want to chat through your specific goals, your current portfolios, and understand how you might want to make some adjustments through time. You'll get a link to re-sign up to that for anyone that hasn't already done it. But thank you so much for joining us today. Simon, thanks for taking us through the investment side of things. I hope you've all enjoyed this session, and we look forward to speaking with you again in due course.
Goodbye all.